Let's start at the investment bank then, where you're all going to apply. Trading and portfolio management. So if you're a professional trader at an investment bank, if you're a professional trader at an investment bank, 90% of your time is spent being a market maker. You make markets in the assets that you trade to clients. 10% of your time is spent as a proprietary trader, so using the bank's money to make money. And it's called proprietary trading because it's really everything that the trader does that's proprietary to doing business with clients. So it's going to be pretty important to work out, if you're all applying to investment banks, what the hell a market maker does. Because that's what you'll be doing 90% of the day. If you go there for 10 years, you'll be doing it for 10 years. So you need to know. Market making on the secondary market side is the bread and butter of the business. And it splits up into two areas, agency and risk business. It's the bread and butter of the business because it's the commission business. It's the backbone of all the profit of the company. And I'll explain in more detail why as we go along. It becomes very, very obvious. These days, a typical commission on the secondary market side in equities is 5 basis points. So 100 basis points is 1%. Typical commission is 5 basis points. So if we're looking at an agency example, and by the way, agency is 80% of all market making business these days. We can use this example. It's very, very straightforward. A client, a hedge fund or a pension fund of the bank on the secondary market side decides they want to buy $10 million of Apple at $500 a share. So they want to buy 20,000 shares in Apple. They've got two choices when they call the investment bank. They can either give it to the investment bank to execute on their behalf in the market, where the bank does it with no risk, or they can ask the bank to commit capital, so ask the bank for risk. Agency is when the investment bank takes no risk. They buy it on behalf of the client. Now that can be done over the telephone, or it can be done over the computer. So the client can actually put the order into the order management system, and it goes directly to the investment bank, pops up on the screen of the salesperson. The salesperson clicks send. It goes to the trader clicks right mouse, send to the computer. The bank hasn't taken any risk. They're buying it on behalf of the client. When it's done over the phone, the dealer at the pension fund or the hedge fund calls the salesperson and says, take an order for 20,000 shares in Apple to buy at 500. The sales trader enters it and sends it to the trader. The trader accepts, right mouses, puts it in the computer. Either way, it goes in the computer. But in this example, let's have a look at the way the business works. In this example, the clients decided to buy $10 million of Apple, 20,000 shares. The bank gets paid 5 basis points for just doing nothing. Whether it's put in the machine by the client directly or done over the telephone, they haven't committed any capital. It's risk-free. What about the risk business? The risk business in market making, that transaction is done slightly differently. This makes up about 20% of all market making. So instead of the order going directly to the bank or via the salesperson, directly to the trader or via the salesperson and put in a machine, they're going to the salesperson and asking the bank to commit capital. So they ask the trader via the salesperson to sell the 20,000 shares to the client. The trader ends up short 20,000 shares and has to go into the market to buy them back. If the stock goes down, they obviously make money. If the stock goes up, they lose money. Market makers are measured on their ability to retain the commission that the bank is getting paid. So imagine if you're running your business on the trading desk at one of the investment banks, and over the whole year you get paid $50 million commission. The bank gets paid $50 million commission. For you to do that business, to bring that 50 million in, you had to commit capital in at least 20% of the orders. So let's say you lost $10 million doing that. Well, you've got a retention ratio of 80%, which is very good. In this example, the retention ratio is 60%. So a bad retention ratio is 50%, a good one is 75%. Your ability as a market maker is measured on how much commission you retain. So market making, it's what 90% of the time traders are market making at investment banks, not prop trading. This is what you'll be doing the vast majority of your day. That's what you're applying for. It's split up into agency and risk business, but 80% of the time, it's outsourced to a machine. And 20%, the market maker is required to take risk to the client. So we're just doing 80 times 90 here. 72% of the time, a professional trader these days at an investment bank, the day is spent monitoring software. It's spent monitoring algorithms. Because the software, the algorithms are processing agency orders. And they may have lots of these all happening at the same time. So 72% of a trader's time is spent at an investment bank monitoring algorithms. Does that sound sexy? There's no human skill in market making anymore. 10 years ago there was. However, the industry has been in structural decline for over a decade. What you're applying now to is a totally different industry to what it was 10 years ago. What was the typical commission number that we looked at before? Can anyone remember? 5 basis points. What do you think the industry standard was 10, 12 years ago? I wish. Huh? Almost. It was around 25 basis points was industry standard 10, 12 years ago. Now, if commission is the bread and butter of the secondary market side, and it's gone from 25 down to 5, that's down 80%. What do you think's happened to everything at the investment bank? Because everything relies on it. Everything's down 80%. This is the problem that you face now. The other 18% of the time of the market maker, if you think about that trade that we looked at in Apple, where the market maker commits capital and sells the apple to the client, do you think that trader actually wants to do that trade? Well, it's a catch-22 situation. Because when the client comes in and says, I want to buy $10 million of Apple, 20,000 shares, can you sell them to me at 500? If the guy says no, if the trader says no, 3 seconds later the trade's done at the investment bank around the corner. There's competition still in the industry. Of course there is. So they're kind of forced to do the transaction. They don't really want to do it. They don't want to commit the capital, but they'll do it if, on balance, it's worth doing. So they're kind of forced to do it. So the other 18% of the time, unfortunately, what you'll be doing at an investment bank these days is putting out fires. You'll be unwinding positions that you don't want to have. So 72% of the time, you'll be watching machines trade, making sure they're not screwing anything up. If they screw it up, you do a right mouse, you pull the order out the market. When the machine behaves or wants to behave, you right mouse and put the order back in the market. The other 18% of the time, you're scrambling around to get out of risk that you don't want. That's the job of a market maker. That's 90% of what a trader does at an investment bank. That situation where you've got lots of positions that you don't want to have, that is termed in the industry as the negative selection portfolio. Those positions have been negatively selected. You didn't really want to have them. You got given them by the clients. And now you're spending your time trying to get out of them. So 80 to 90% of a professional trader's time at an investment bank, it's not spent actually taking or trading positions that they want to have. It's spent market making and monitoring algorithms. The machines in market making have replaced humans in the business. There's no skill in market making anymore. Now we're going to come on to pay later, what people get paid at investment banks, but it seems pretty logical that if the commission is down 80% over the last decade, what do we think pay is down? It's down roughly by the same amount. But first we're going to look at prop trading. Prop trading is pretty much 10% of a trader's time at an investment bank. That's using the bank's money to make money. Why do you think the bank would give the trader capital to enable them to take positions? Obviously to make money, but why do they want them to make money doing this? Think about that negative selection portfolio. Over many, many trades, over a year, over a financial year, there will always be a loss in doing business with clients because they still have to commit capital. So they will always lose some of the commission over the year. And they'll always have the negative selection portfolio throughout the year. But why do you think the bank gives them money to trade on a proprietary basis? Any guesses?
Offset the losses.
Exactly. So the bank gives them a pot of money to trade with in positions that they want to have. So they allow them to have or invest in a positive selection portfolio. And that number that's given to them is designed to make a return that outweighs the loss committing capital and doing business with clients. So that example earlier, 50 million commission over a year, lose 10 million of that commission doing business to generate the business to come through the door. The bank might give you 50 million to make the 10 million back in positions that you actually want to have. And typically, and this goes against pretty much all perceptions outside the industry. Typically, they're running long-short portfolios with 1 to 3 month time horizon. They're not actually going in and out the market every couple of minutes, every couple of hours, trying to make money quickly. They're actually holding positions for a long time. So they're running portfolios. So the purpose is to try and make that money back. But it's also linked to the trader's bonus. That's where the trader gets paid their bonus. If they make money proprietary trading in positions that they want to have, that's where their bonus comes from. Now, if commission is the bread and butter of the business, and it's down 80% in the last 10, 12 years, what do you think the number is in terms of what the bank gives traders to enable them to trade with in the proprietary trading account? How much do you think that's down? About the same. Because that commission number at the bank is collateralized to enable the traders to take more risk. So if that's down 80%, the number that they give to the traders is down 80%. These days, you'll be lucky to get $50 million, even as a senior trader. Whereas junior traders 10 years ago were getting $250 million. So they could actually earn a bonus. So that means, all things being equal, bonuses are down 80%. Am I depressing people here? You don't need to get depressed. You've just got to deal with the market that you've inherited. When I joined the industry in '99, well, in all times or points in time, it's a trader's job to follow where the opportunities are, where the money can be made. In '98, '99, when I was applying to investment banks, it was valid because investment banks were places where you could make a lot of money. It's totally changed now. What you've got to do now is deal with the market that you've inherited and still follow where the opportunities are. But we'll come on to that later.